My name is Michael Guyette, publisher of the Lead Lag Report. Joining me for the hour is Mr. Mike Singleton, who I've been trying to get on these spaces for a bit of time here. Mike is a fellow CFA charter holder, which means he is as good at predicting the future as I am, which means we're just trying to figure it out like everybody else. So, Mike, introduce yourself to the audience. Who are you? How'd you get involved, interested in markets? And tell us a little bit about Invictus.
Sure. So my name is Mike Singleton. I am the senior analyst and principal at Invictus Research. I got my started in finance and markets probably in college. I went to the University of Notre Dame. Notre Dame tends to have a very value investing oriented finance program, which is great. I had a very good experience there. I really enjoyed it. I had the good fortune of working at a very good private investment firm after my time at Notre Dame. It was also very bottom up, very kind of dyed in the wool, Ben Graham, Warren Buffett. And like I said, that was a fantastic experience. I got a lot of responsibility from a young age, got to lead my own investments very early on, kind of unusual in that way. So I got to travel to conferences, meet a lot of really interesting people, go to ideas dinners, pitch ideas. And, I learned a lot. And one of the things that I noticed is that Wall Street attracts a lot of really, really smart people. And one of the things that I observed about those smart people was that when they would get things wrong about markets or about some idea that they covered, it wasn't because they didn't know their stock well enough. It wasn't because the technology guy, particularly on the buy side, didn't know his area of coverage super well. Usually people know their area of coverage very well. I found it was usually because they missed the forest for the trees and they would miss stuff on the business cycle. And during my time as an analyst at this firm, I got the opportunity to meet sort of a more top-down mentor who had more experience in sort of macro business cycle analysis. And over time, I observed that he was getting a lot of things right that I was getting wrong. And my firm did very well and had a good track record and whatnot. But this mentor had a better track record. And after a while, I sort of figured I've got to learn what he's doing, because I think that I could really enhance my own stock picking skills and my value as an analyst if I start to integrate some of the top-down work with my bottom-up work. And it did. It ended up being a really, really important part of my process, an important part of my process at the firm. And now, sort of next step, after a few years, I figured that I could probably create more value starting out on my own. And so I did. And that's how Invictus was started. And as it happens, Invictus focuses more on the top down. So Invictus is sort of a boutique macroeconomic and market strategy firm.
Why the name Invictus? I mean, I know from the Latin definition, but why choose that as the name?
I like the William Henley poem. I don't know if that's really the reason. I think that the truth is that most of the really good names in finance are taken. And Invictus was one of the last good ones, so I had to take it.
Fair enough. All right, let's talk about the forest for the trees, because sometimes the trees burning can burn down the forests, right? Which may be a good analogy for what's happening with some of these regional banks this week. First, I want to get your take on what's happened the last 48 hours. I've been catching up myself. I've been pretty consistent on this idea that March will be volatile closer to the end of the month. Seems like it's happening earlier. I've been pretty consistent in saying I think there's a credit event out there. I actually don't think this is it. I want to get your take on what's happened here.
Yeah, it's a good question, and I'm not a bank analyst, and I haven't had the time to sort of go through Silicon Valley Bank's balance sheet or anything like that, at least not yet. So I guess maybe I would start with the premise that when growth is slowing, bad things tend to happen. And we've seen strong growth numbers, particularly consumption numbers in January and February. But if you zoom out a little bit, growth has actually been slowing for a while now. And if you look back at history and the performance and relative performance of financial stocks, and especially bank stocks, they're super cyclical. And so is it really that surprising to see bank stocks breaking down? It's sort of a technical turn of phrase, but breaking down in both absolute and relative terms through an economic backdrop where growth is slowing? No, that shouldn't be surprising at all. That's kind of exactly what happens historically. The financial sector and the banking industry are two of the most pro-cyclical risk exposures out there. And so more than anything, I would just say that it's sort of confirmation that the market is continuing to price in what I view and the house view at Invictus sees as sort of a global, a slow but global deflation.
Okay, so that's an interesting direction to go, this idea of a kind of a slow but global deflation. Now, I was admittedly early last year when I kept on making this point, but I still maintain this view that inflation shocks are inherently deflationary, because when you have an inflation shock, margins get hit, there's an overreaction, and that overreaction causes the credit event, which ultimately is inherently deflationary. Talk through to the audience, what's your thesis? Why is it that you think that despite all this hand-wringing around we're in a secular inflation environment, that's maybe not the way things play out?
So first, I feel like when you say the word deflation, there are a lot of people that think maybe you're not acknowledging the fact that inflation is still running hot. Inflation is definitely still running hot. But when I say deflation, what I really mean is that inflation is slowing in rate of change terms. So
disinflation, right?
Yeah, disinflation. Yeah, no, exactly. So, what we actually have is sort of a slow deflation with tightening monetary policy, because even though inflation is falling, it's not falling fast enough to be satisfactory to the Federal Reserve. That said, bigger picture, I think it's helpful to take a step back and sort of think about how the policy cycle interacts with the growth cycle, because that's how we contextualize a lot of our work at Invictus. So, and I know that I think you've done a lot of work on this as well, Michael, and it's been really good. I've enjoyed a lot of your papers. So first, how does it start? Well, the Fed raises rates. We've seen that happen. And when the Fed raises the Fed funds rate, that puts upward pressure on the entire interest rate complex, and including mortgage rates. So that's kind of what I'm going to focus on. So mortgage rates go up. Pretty much as soon as mortgage rates go up, demand for housing goes down because housing becomes more expensive. And you can see that in a few different ways, but probably the most obvious is the mortgage application data from the MBA. I think per the most recent report, mortgage applications for new home purchases are down 60%. I think that could fairly be characterized as a crash. Eventually, if demand for new homes stays down long enough, which at this point I think it has, you'll see home builders start to build fewer homes. I think new home starts are down about 28% year over year. That's pretty consistent with pre-recessionary periods in the past. Around the same time, consumers will spend less money on household goods, durable goods, sort of big, expensive items, oftentimes financeable, that last longer than 3 years. So think cars, refrigerators, other home appliances, furniture. So we saw a bounce in January in durable goods spending, probably in response to the decline in rates between October and January. But if you, again, take a bigger picture, zoomed out view a little bit, durable goods spending has been going down. Manufacturers have been getting the picture that demand is going to be slower, and you've seen industrial production come down. You've seen the PMI data come down, which tends to lead the Federal Reserve Board's industrial production data by about 4 months. And so what would we expect to see next in the business cycle? We would expect to see layoffs next. And more specifically, we would expect to see layoffs in a few specific cyclical sectors: manufacturing, goods producing sectors, construction. And we are not seeing that yet. So, and we just got the employment situation report this morning, and we continue to see strong headline numbers, but also strong job additions in sort of those cyclical categories I just mentioned. And so at Invictus, we like to say that we're kind of in the fifth or sixth inning of this downdraft in economic growth. And the thing that we're keeping our eye out for next is for layoffs. And we have a number of leading indicators for this. It's obviously a pretty challenging item to forecast, but our estimates say that we are likely to see some preliminary weakness in the headline numbers of the labor market. So like initial claims, the unemployment rate in Q3 of 2023, and then more of a nonlinear recessionary looking spike by the end of Q4. So call it November or December, we think, at the earliest, and just as likely in early Q1 of 2024. So that's sort of the big picture on how we're viewing the world right now.
Has it been surprising to you that the jobs market hasn't responded more negatively? I mean, I get it, everyone's short term, and I get it that these things act with lags, obviously, but there does seem to be a bit of a confounding aspect of the way the economy is responding to where we are in the cycle compared to history.
Yes, it's I guess it's been a little surprising. I think there are sort of a number of ways that you can gauge the impact of interest rates on the labor market. Our model suggests that you won't really see the brunt of the tightening from 2022 until Q3 of 2023. So I can sort of look around anecdotally and say, I think firms should be laying people off. I think that would make sense given the economic backdrop. But my models, which are sort of more quantitative in nature, say that historically, if you just took the historical leads and lags of monetary policy, we shouldn't expect to see it with a high level of confidence until the second half of 2023. But I don't know. I mean, I could make up reasons why firms aren't laying anyone off yet. There's been a lot of money printing. As a result, aggregate demand is really hot compared to supply, blah, 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 whatever. But I'm sort of sticking with that second half Q3 story. Everything I'm seeing so far seems to indicate that's the most likely outcome.
How does the yield curve inversion play into that, right? So as I recall, usually it's actually when you're starting to enter into the meat of recession that you see steepening. It's actually the opposite, right? The inversion happens before the recession happens, the recession unfolds, and it starts seeing the opposite of the inversion. Do you think the yield curve inversion is as strong of a signal or message as people make it out to be in this environment, in this cycle? Because it seems like every single time you think it's not going to get more inverted, it does.
That's true. I think history, given the data that we have, shows us that when you're going through a really aggressive inflationary cycle, the yield curve can get more inverted. I think the underlying economic logic for that is that the Fed will have to tighten more aggressively. And you've pointed this out on your Twitter account before, I think. Generally, the yield curve will steepen or uninvert when the Fed realizes, oh, wow, we've tightened maybe too aggressively and we need to stop tightening. And that's when a recession is either visible at that point or going to become visible pretty soon. So, why is the yield curve still steep? Well, it's because the Fed is still tightening. And when will it start to steepen again? Probably when the Fed realizes it's too late. I don't think that'll happen for a little while. In terms of its accuracy, I think the yield curve is a very good indicator. I don't think it's the best leading indicator. It tends to lead. This is the way we think about it at Invictus. It tends to lead the growth cycle by 10 to 12 months, and stocks, more or less trade coincidentally with the growth cycle. So it doesn't have the highest forward correlation with the growth cycle, but it has a very good one. It's not something that we would ignore. And the economic logic for why the yield curve matters also makes a lot of sense. So the short end of the yield curve tends to trade pretty much 100% on expectations about Fed policy and forward guidance. And you can just run a simple regression of, a short rate, the 1 year, 2 year, 3 month, whatever, against the Fed funds rate. And it's, virtually entirely explainable by whatever the Fed is doing. Long rates are also highly, highly, highly correlated with what the Fed is doing, with the Fed funds rate. But it's more like an R squared of 0.8, right? So it's 80% explainable by what the Fed is doing. The other 20% is the bond market's outlook for growth. So when you see the yield curve invert, what it means is that the Fed is tightening, and they've tightened enough that it's going to affect growth in the out months. And as it happens, it tends to be 10 to 12 months out. And so we take that very seriously because we take the Fed very seriously and we take the bond market very seriously. And historically, it's been a relatively reliable indicator. So certainly not bullish.
But I would argue it's a bit odd that you have an inversion with credit spreads getting tighter and tighter, right? I mean, you would expect that if it's a signal of recession, that credit spreads, default risk premiums would start to get priced in. And that's been a pretty strange dynamic that despite what looks like a bond market saying recession is incoming, credit spreads are not really giving the same message.
Right. Credit spreads by our work tend to be a much shorter term leading indicator. They tend to lead economic growth, called the ISM manufacturing PMI, by about a month, but with a much closer correlation. So I think that if you were trying to read the tea leaves of the market, what you would say is we're going to have trouble. The yield curve is inverted, but the recession isn't imminent yet. Right? Like you said earlier, the credit event isn't right now. At Invictus, we're inclined to say it's probably Q4 of 2023, maybe a little later.
Yeah, I mean, that lines up with some of the other work I've been saying that I think it's closer to the end of the year, which, by the way, that would coincide with, if you go with the idea that markets tend to discount things, let's call it 9 months in advance. Well, you have a lot of rollovers of corporate loans in 2024, which the market would presumably start to respond off of in advance in 2023, but later in the year. So, I mean, I think you and I are kind of thinking about the time frame similarly, just from different perspectives.
Yeah, I think that's right.
Let's go to some of the audience.
Good question. I think big picture, what are the factors that really drive returns at the asset class level? Tends to be real growth, inflation, and monetary policy. So right now, I would say that we're in a deflationary regime in the sense that growth and inflation are declining simultaneously. That's what I mean when I say deflation. Not that we're going to have negative inflation, at least not anytime right away. So I think what I would expect is probably, for as long as growth is slowing, you would expect defensive sectors and risk exposures to outperform cyclical ones. You would expect, especially as monetary policy continues to be tight and get tighter, you expect value exposures, short duration exposures, to outperform growthy or long duration exposures. So in the stock market, that would mean statistically cheap stocks versus expensive ones. And in the bond market, it would mean short duration bonds over long duration bonds. And, a lot of the inflationary, you'd expect through deflation, inflationary equity exposures to underperform. So think energy in particular, but also the different sub-industries within basic materials. So far, the inflationary equity exposures look okay. I mean, they're not doing fantastically well, at least not over the last few quarters, but they're certainly not pricing in a recession yet. When they do price in a recession, well, just look at any other past recession and look at how energy stocks have performed really badly. That's what I would expect, going into the end of 2023, beginning of 2024. Sure, I'll do my best to answer those. Hopefully, I don't forget. I would say that you're thinking about labor hoarding. It's a good question. Here's what I'm thinking about. I would say, what's the biggest risk to that thesis we laid out earlier between the growth cycle and the policy cycle, and how the Fed's tightening flows through the economy? And so far, we haven't been seeing layoffs in these cyclical sectors, manufacturing, construction, et cetera. That's really a necessary. It's sad because layoffs are the collateral damage, but that's sort of a necessary transmission mechanism for Fed policy, is that the manufacturing sector gets slammed. So if you think about the hiring patterns of the manufacturing sector, and and services too, but especially manufacturing, over the last few years, there was a giant pandemic. They had to let a bunch of people go all at once. The Fed stimulated super hard, essentially signaling that they needed to hire everyone really fast. And then they did the fastest, most aggressive switch from easing policy to tightening policy that we've ever seen. So now they're signaling that these manufacturing companies need to fire everyone. And I think it's possible that these companies have whiplash. And there's not just logistical challenges with hiring and firing people that quickly, but there's reputational risks. And it's possible that these manufacturing companies may be willing to see margins compress more than historically they would, just because that's such an absurd scenario that you need to hire and fire people so quickly at the behest of the Fed's influence on the economy. So that's someplace that we could be wrong, and that would result in an elongated business cycle. That's where we would be wrong. It would be probably higher rates for longer, and maybe the recession isn't until late 2024, early 2025. Not our base case, but definitely a risk. That's the biggest risk to our thesis in the labor market, we think. And then to your question about RIAs, I'll try and answer that quickly. I think the reason that passive investing has been so successful, there's obviously a lot of different reasons, but probably the big one is that the S&P has returned, mid to high teens between 2010 and 2020, something like that, right? So we have a number of long-term forecasting models at Invictus that are based on valuation and positioning, essentially. For example, the Shiller price to earnings ratio, Fed's flow of funds data, and household exposure to equity. And these statistics tend to have an amazingly close correlation with 10-year forward returns. And so what they're indicating to us is that over the next 10 years, we're going to see 0 to 4% real returns per year in the S&P 500. That's obviously not going to look quite as good for people that are just owning the S&P 500, and there's going to be a lot more opportunity for active managers to outperform. And so just given that setup, my base case is probably that active management is going to have a good decade. Could certainly be wrong, but that's sort of what I'm thinking right now. The RIAs that I talk to, I would say it's pretty mixed. Invictus was founded in late 2021, so I don't know if my sample size goes back long enough to be super helpful here. But I can tell you that there are plenty of RIAs that didn't own energy for a very long time, and then they drew down 25% plus in 2022 and watched the energy sector outperform by, 50 points or something. And all of a sudden, active management started to look more interesting to them. I don't think it'll take them that long to adapt. And interestingly, I've noticed a little bit of difference in terms of geography. I've noticed that people on the West Coast tend to be much more interested in continuing to own tech-heavy portfolios, or maybe even the S&P, because it tends to have more tech. They've been slow to give that up. Whereas elsewhere in the country, the East Coast, the Midwest, it seems like people have been a little more flexible. But again, very small sample size, so take that with a grain of salt.
Again, everybody here, please make sure you follow Mike Singleton if you're curious to learn more about Invictus. I encourage you to take a look at his website and some of his work that he's done. This will be an edited podcast on all your favorite platforms. And again, if you want to come up and ask questions, click that bottom left mic request button. I want to get your thoughts on currency for a bit here, Mike. I was just kind of perusing through the video that you sent me, and you noted a dollar weakness, right? And even today, unusual, right? Everyone's saying it's risk off type of thing. Treasuries are responding, but the dollar not so much. Yes, dollar responded very well last year, but it's clearly not the same type of interaction against volatility so far. What are your thoughts on currency movement, and maybe in particular currency volatility given your macro framework?
So we spend a lot of time thinking about the dollar. Generally speaking, we look at the dollar and foreign currencies in general more from a signaling perspective than from an investment perspective, right? What are the macroeconomic implications of the dollar moving higher or lower for stocks? And what are the implications for this, the stock market and market internals? So, you're right. In 2022, we saw the dollar perform very well. And I think its performance was pretty clearly attributable to the Fed raising rates very quickly and raising rates more quickly than anyone else, pretty much. And so you saw inflation obviously perk up quite a bit in Europe. And we're US focused at Invictus, but pay enough attention to understand this dynamic at least. Inflation began to pick up much more quickly in Europe. And so the ECB became much more hawkish. And so that interest rate differential between the Eurozone and the US narrowed quite a bit, which resulted, and because the Euro is a 58% weighting in the Dixie Dollar Index, you saw the dollar come way down. So, that was a big move from a technical perspective. It covered a lot of ground. We're still bullish the dollar above 103, the Dixie Dollar Index above 103. High level for a second. What drives the dollar? Interest rate differentials, like we just said, but also risk on, risk off. The dollar is the primary global reserve currency. If you look at the rate of change of the dollar versus the economic data, generally the dollar it goes up when growth is going down, and it goes down when growth is going up. Again, it's sort of a risk-off safety asset. And so if our view is that we're going to have a recession in the US by the end of 2023 or beginning of 2024, and generally there are not a lot of, I don't know if there's any periods where the US goes into a recession and doesn't drag the rest of the world in with it. It's hard to imagine the dollar not performing well. So, we're inclined to be bullish on the dollar. If we saw a big aggressive breakdown below 103 in the Dixie, that would be strong technical evidence against that view. But as long as it's above that level or, thereabouts, we think that's supportive of our overall thesis. Well, the logic is that if the benchmark is performing really, really well, earning 99th percentile returns historically, then that means it's hard to beat for anyone making active investment decisions. But if it's performing less well, the competition is just easier, so to speak. I'll also add that this isn't necessarily a forecast, but historically, the periods where, real equity returns have been low for a 10-year period, alternative assets have performed really, really well. So think like energy stocks, commodities. It tends to be through inflationary period. And if an active investor is discerning, that's a lot of outperformance, right? If you think about the 1970s, commodities outperformed the stock market by, I think it was double digits. There's no reason a discerning active manager shouldn't be able to take advantage of that.
Yeah, it's interesting. It's an interesting point. And Mike, I'm with you. I think this point is very valid and selfish that I want to see that, right? Because it's true. It is, again, I go back to, it's been really hard to beat the S&P because it's been the place to be. There's been no alpha, which is why a lot of these active managers went away.
Yeah, no, that all makes sense. I didn't really understand his point at first, but I was more making a point about the opportunity in front of active managers and less a statement about when historically active managers have outperformed or underperformed. But his logic makes perfect sense.
Yeah, and also it does go back to, I think, volatility, right? I mean, I think the historical return attribution will argue that active tends to do better when there's more volatility, more tail risk, because the idea there is that it's not necessarily active on the upside, it's active on trying to mitigate the downside, which means you need to have some downside for that to matter. So let's continue with sort of the macro backdrop. Do you do any sector work when you look at the economy, when you try to frame things? I mean, I see the chart you have on the video around cyclicals versus defensives as a ratio, as an argument for maybe choppiness, which I don't disagree with. But talk through sort of how you're viewing different sectors and the kind of offensive defensive rotations that might be happening.
Sure. So I think there are a few. We probably view it as much from a factor perspective as from a sector perspective. But there are, on a high level, there are pro-cyclical sectors and there are defensive ones. And so if our view is that growth is slowing, we're going to go with the defensive ones. And then within the cyclical sectors, there's the growthier types. Those tend to be more maybe just by virtue of their composition with these giant large cap stocks, they tend to be consumer discretionary, communications, and technology. And the more value oriented cyclicals tend to be energy, industrials, financials, basic materials. At Invictus, we're much more inclined toward the value cyclicals if we have to go towards cyclicals, but we'll screen on technicals too, right? So like financials are, tend to be more value oriented cyclicals. Even banks tend to be even more value oriented within financials, but their technicals look terrible right now. So we would not own them, right? You're seeing sort of breakdowns all over the place, and they weren't great even before this week. And then if we can own cheap defensives, that's really the best combination of style factors. So if we can find cheap utility stocks, cheap healthcare stocks, cheap consumer staple stocks, history tells us that's kind of the place to be right now.
So, Mike, I'm curious, when did you get your CFA charter?
My third test was in the middle of COVID, and it got canceled like 3 times. So it was a rough experience, but I guess it was spring of 2021.
So I got mine in 2008, which was rough in a different way, given the great financial crisis. But I'm curious, now that you've gone through the exams and we're in this really weird environment post-COVID, you find that the stuff from the CFA curriculum is applicable to the environment that we're in now? I mean, on average, sure, this stuff has, I think much clearer cause and effect, but we're in a weird environment. Like I often wonder if people that take the CFA exams now look at what's happening around us and say, yeah, this wasn't exactly taught on level 2.
Yeah, I've gotten a few questions about the CFA versus the CMT. And I think that the CMT is kind of what the CFA is lacking a little bit. The CFA is very cerebral, very fundamentally oriented. It covers a lot of very esoteric topics and not very much detail, which means you're spending a lot of mental bandwidth learning about things that are not super helpful on the job necessarily. I think a lot of CFA charter holders would probably benefit from spending more time analyzing markets and what it signals when the markets do one thing versus another. And a lot of the stuff that you talk about, right? Sequencing, different regimes, what performs well in this regime versus that. What does it mean when lumber is outperforming gold or underperforming gold? Candidly, those are the things that I think should be added to the CFA curriculum.
Yeah, and it's not like, as long as the causation makes sense. I'm with you on the technical analysis side. I see David Nikoski is here. I think he'd probably agree too. There's a lot of stuff that is probably more random. It's like, I'm not a big fan of like pattern-based technical analysis, right? Where it's like, oh, here's a head and shoulders, and it's okay. Or, it's like all this stuff may work, may not. I just don't know if you can actually test it to prove it. But, to the extent that there's an intermarket leading aspect of certain parts of the marketplace that are rooted in fundamentals, rooted in the economy, like lumber, housing, utilities, interest rates, bonds, that I think I agree that it kind of makes sense. And that actually, I think, lends itself to a question around time frame. Whenever you put a macro outlook together, I had Lakshman Achuthan on last week, and the time frame thing is always interesting for economists because it can take a while for economic projections to change because it's on a very kind of slow lag basis in terms of the variables that are looked at. For you, when you come up with a macro thesis, what are you on the lookout for causing you to change sooner than later a view, if it's not necessarily based on market price action in the here and now?
So we have, call it 10 or 12 leading indicators for inflation, 10 or 12 leading indicators for growth. And then we try to understand the historical sequencing of the business cycle. And on top of that, there's a bunch of, back tests that we run to try and determine what the market is pricing in the moment. And so generally, what we're looking for is when all of those things tend to match up together. And when they're not matching up together, is it because we're getting an indication that the cycle is about to change? We're about to go to a new regime, right? Is deflation about to become reflation? So, right now we're at this point where we're in sort of a slow deflation, but inflation is still too high to be satisfactory to the Fed. And so they're continuing to tighten policy, knowing that the transmission mechanism for this next step in policy is layoffs. So if we don't see layoffs by, call it like Q3, that would be one indication that, this business cycle is going to be different than the next one. If we see the market internal start to shift in a way that's sort of a red flag for long enough, that would be another indication, right? Markets are signaling or telling us as analysts of the market that things are maybe different, right? If we saw a prolonged period of outperformance from cyclical sectors, if banks were breaking out instead of breaking down, for example, that would be counter evidence to our thesis. If the Fed started stimulating again for some reason, that would obviously break our thesis. That said, it's sort of a weight of the evidence approach, right? We're looking at a lot of different things. We're looking at, what the market's telling us, what the sequencing is, paying attention to what the Fed is actually telling us, and then we try and take that weight of the evidence and form the most logical conclusion. And then, like I said, all of the leading indicators too. Sure, it's a great question, and there are more brilliant people than me discussing it. I guess maybe one analogy that I occasionally use is, global commerce is kind of like a supermarket. Most of the things that you want to buy, as you pointed out, are denominated in dollars, particularly commodities. And there are some efforts to sort of change that on the margins, but they're probably going to be pretty slow. You could think about the yuan, the yuan in this analogy as a cryptocurrency, right? You can't go to most grocery stores and start buying groceries with a cryptocurrency. And then if you lose your job, there's a good chance you're probably going to sell your cryptocurrency into dollars so that you can cover your bare essentials, right? And so I think a bet that the dollar is going to devalue because of lack of use before there's a global recession that forces everyone to sort of cover their bets and buy dollars is probably not a bet that I would make right now. At least it doesn't seem like a good risk reward to me. I think that what you're describing is probably a much longer term thesis.
I mean, I do think I think that response is right. It's if the U.S. dollar is going to be challenged, it's going to be a long drawn out war. A lot of people talk about the death of the dollar, but the reality is it's kind of like home construction. It always takes longer and costs more money than people think, right? So it still seems like you've got King Dollar is going to take a while to get dethroned, and presumably you would see the death of the dollar actually in a sustained risk off period, right? In other words, if you had let's envision a scenario where you have really heightened volatility in equities and the dollar just is not getting a bid, but some other currency is relative to the dollar. Like that would be more of a sign that there's confidence going away that the dollar is sort of a safe haven. Like the moment you kill off the idea of the dollar's behavior as a risk off play is, that's probably where that trend asserts, I would think, Mike.
Yeah, I think that's exactly right. I mean, we have just a general principle at Invictus that, big trending moves in asset prices are always reflections of big trending moves in the fundamentals. And so that's why we read the market signal, right? Is if the market is signaling to us that there's a big trending move happening that we're missing, that's kind of a safeguard. And like you said, if the dollar started to underperform through a risk off period, that would be probably the market shouting at you that something's different this time, and people don't want dollars for some reason, and maybe your strong dollar thesis, needs to change.
What do you think people get wrong about the current macro environment? Again, I keep going back to there's a lot of weird things that are happening based on price action versus narrative. What are people getting wrong from the research that you're doing that people would say, well, that's odd, but you'd counter and say, no, the facts actually, or the data says, you have it right and they don't?
I'd say the thing that I'm spending the most time thinking about or maybe rebutting right now is, so we've seen very strong economic data, particularly consumption data in January. So what's happening? Why are we seeing stronger consumption data? Is it because it's a new recovery? I don't think so. It doesn't really make any sense to me, given where we are in the business cycle. There's nothing to recover from. Unemployment's at secular lows. Corporate profits are within a few percent of all-time highs. The best explanation that I would give for why we've seen, personal consumption expenditure spike, durable goods spending spike, is that interest rates drifted down between October and January, and that unlocked some marginal demand for durable goods. All else equal, more demand will mean sort of faster growth or faster headline growth numbers and faster inflation. And so we've seen sort of inflationary momentum for durables accelerating on the margins. And I think a lot of people are sort of interpreting that as a reflationary impulse. And you've seen markets react to it. You've seen some cyclical exposures sort of outperform in the face of that, at least over a, relatively short period of time. So I would say I would not be buying those breakouts or those moves in cyclicals thinking that this is a new bull market. I think that this is sort of a transitory bounce in demand for goods. And I think that it's also an input into the Fed's policy reaction function, right? They don't want to see this. The Fed is not supporting this mini reflation, if you want to call it that, and they'll continue to tighten until reflation is no more. And with services inflation running 6 or 7% on an annualized basis, a 3-month annualized basis, a resurgence in demand and inflation for durable goods is really the last thing that they want to see. And that's the ticket to higher, faster for longer rate hikes. In which case, even if the economy doesn't break, it didn't break in 2022, it's still not a good environment for financial assets.
Yeah, no, and it's like this is the thing about every time I've said melt up, and like on down days, like people are like, oh, what if you're melt up? Again, it's like I think it's possible that you see nominal new highs because we're in a pre-election year, right? And pre-election years tend to be good anyway, just cycle work wise for equities, but that's nominal, not necessarily real. I myself, I think you and I are probably aligned on this idea that the bear market is really not over in real terms.
No, I don't think so. And I have a question for your seasonality thesis there. So I've seen the charts about pre-election year seasonality. I'm admittedly not a huge seasonality analyst, but I've also seen that a lot of that seasonality can be explained by stimulus. So there's, obviously political motivations for politicians to stimulate into a re-election year. That tends to help, stocks. I'm inclined to think we're not going to get any kind of stimulus. I think we're probably going to get cuts in the face of the debt ceiling negotiations, and sort of the fiscal impulse measures that we evaluate at Invictus with longer lead times point to no fiscal aid, at any point in the near future. If the reason for that seasonality doesn't come to pass this year, do you think that the seasonality effect and prices will still happen?
So I'd have to look at it myself, but my counter to that would be, it's not clear to me if stimulus from China, for example, would still be enough to keep that reasoning in place, right? In other words, yes, so I'm with you. You want to get the fiscal impulse around the pre-election year because of where we are in terms of inflation, but you are getting some kind of a fiscal impulse with China, right? And the reopening and the economic activity there. So Louis Vincent Gov of GovCal, I posed this question around this idea of recession this year, and his counter was, we're not going to have a recession because China is about to actually reaccelerate. So I don't know. It's a good, actually a very your observation, I think, is actually spot on in terms of how to think about why the seasonality exists. And yes, it is because of that idea that stimulus by the existing incumbent party to stay in power for the election. But I do wonder if it's ultimately about stimulus. I wonder if China's stimulus might be enough to keep that seasonality in play.
Okay, yeah, no, that's a good point.
I don't know. It's an interesting thought experiment, right? Just to think through. But you never know. I mean, listen, if it turns out that I'm wrong and we're wrong that the credit event actually is here, there's going to be stimulus. It's just going to be stimulus after a big decline,
right?
Right? It goes back to path, right? I mean, maybe the stimulus is just late in the latter half if it's actually starting here. I don't think it is, right? But I'm just saying it's not. I can envision that markets are funny in how they surprise people, bulls and bears. I'd argue, but
right. Not to be too skeptical of any of the seasonality charts because I've certainly been surprised by how accurate they turn out to be before.
Yeah, and it's funny because like I had Jeffrey Hirsch on, and to him, like last year was textbook seasonality with the way the stock market behaved. I countered him because I think the sequence was very unusual. Number of weeks down, and again the interaction against treasuries unequivocally anomalous. But yeah, you never know. I mean, it's and also the other thing too is Mike, is like seasonality. All this stuff is on average. I keep going back to 1987 was also a pre-election year. You still had a crash then, right? So it's you always. I agree. You always have to be mindful of the historical relationships to form some kind of a thesis. But the reality is, because we live in the small sample, the single roll of the die can be a totally different outcome than what the average would suggest.
Yeah, right on.
Any other maybe final thoughts here for the audience? Again, everybody, please make sure you follow Mike Singleton, and if you're interested, check out his research, his website. But any other sort of interesting things that you're observing that are not getting as much attention that you think could be a bigger story?
This is not how I usually conduct analysis at Invictus, but it's maybe just sort of a thought I'd throw back at you. It seems odd to suggest that you could shut down the entire economy from 100% to 0% over the course of a month, inject $6 or $7 trillion of total stimulus into the economy, reopen, extremely quickly against that backdrop, and then subsequently tighten monetary policies as fast as we have in a very long time, and have the outcome be new all-time highs for stocks. That seems to defy a lot of economic intuition. Although, like I said, that's not a super rigorous analysis. It's sort of narrative based, but it would seem very odd to think that businesses would become more valuable over the subsequent 5 or 10 years after those types of, economic outcomes and policy decisions. I don't know. What do you think of that?
I don't disagree, and that's why I said nominal versus real. Right? I don't think the bear market's over, but if you end up having nominal new highs, it'll look like the bear market's over. But on a real return basis, it's not. I'd argue. But I agree with you. Right? It's like this is the thing about this. It goes back to that question about having the CFA charter and thinking about markets and the economy. Like there is no precedent for what happened the last 3 years. It's not the 70s. It's not the 40s. People could make these comparisons. I myself would argue that this really is totally new, which means that you shouldn't be surprised by anything, I guess is my point. I mean, listen, the fact that spreads are as tight as they are to me is surprising, right?
Yeah.
Right? I mean, if the start of, like, just think about what we've seen the last year and a half. If you enter 2022 telling people that the dollar would be your best inflation hedge, you would have been laughed out of the room. It's exactly what happened. If you told everybody at the start of 2022 you'd have the fastest rate hike cycle in history, and yet credit spreads would be all-time narrow, right, in terms of the difference. People you think are crazy. If you entered the 2022 saying, I'll bet you that treasuries are going to get smoked, which means utilities, the most bond-like sector of the stock market, has to get smoked. And yet the real story last year was utilities. You'd think that's crazy. So I guess my point in saying all this is, like, whatever seems to be illogical, it's like the last 2 years, the logical thing would be to do the illogical action, or to believe in the illogical.
Yeah. No, I think reminds me of the saying that the market looks to make the most number of fools, or something like that.
Right. It goes back to my point. Like, bear markets make fools of bulls and bears. Right. I mean, it's been weird. And as much as a lot of people are claiming that they saw things coming, I go back to, okay, you can see the endpoint maybe coming, but you can't necessarily see the sequence, which is what's so weird. Right? The path interaction. But I'm with you. I mean, look. I think what the one thing we can all probably agree on is nobody knows what tomorrow brings. And I keep going back to, you have to use history to guide you on what current conditions would suggest, right? So I have a certain framework for conditions. You've got a certain framework for conditions. I think if you have the mentality that it's more about conditions as opposed to this is going to happen, you're going to be surprised less.
Yeah, I think that's exactly right.
I think it's probably a good place to wrap this Twitter space up. Again, everybody, please make sure you follow Mike Singleton. Thank you, Mike. I appreciate it. Thank you everybody for joining.